All right, looks like we're on. Good morning, everyone. Thanks for joining us today on this second in our quarterly webinar series. We're going to be looking at the exploring the energy landscape. I'm Neil Hendricks. I will be your moderator today. If I can find my controls, here we go. And joining me is Andy Kyle and Matt Hobson again. We're going to be covering quite a lot of topics, probably use up the entire hour. Plenty to talk about today in the energy landscape. Certainly, we're going to cover the market updates in each of the regions. We'll also provide a view of the natural gas outlook. We'll cover off some regulatory update as it applies to the U.S. as well. And then we'll have a discussion towards the end that will really explore probably what's one of the hottest topics in energy right now. And that's certainly the load growth that is expected and being announced and being planned for across a lot of the energy markets. So without any further delay, unless you guys have any other comments to make before we get started.
Hey, before we jump in, did you guys stay up and watch the Dallas Stars game last night? I was hoping they'd close it out. Didn't happen. I don't see any Denver-based attendees on the list. So
Four.
we could say we'll hope we finish it out next time.
Or third period.
I was trying to get over my sports sadness, Matt, but thank you. Thanks for starting that way. And just some housekeeping notes too, folks. We are recording this session, so the information will be available following our call today. And certainly, if you have questions, please leverage the Q&A icon at the top, and we will answer those as we move through the information here. And then certainly, if you have questions following the event, please feel free to reach out to any of us. We're happy to talk about any things we cover today. So, gentlemen, I thought to keep things interesting and engaging, we'll play a little presentation trivia and make sure you guys, don't sleepwalk through this thing today, that you actually know the details behind it all. So we're going to kick off with a little bit about the natural gas market. So I'm going to give you a number, and then you guys tell me what you think that number represents.
Ooh.
One.
Yeah. Do you get partial credit for being close in the realm?
No. This is not horseshoes.
Oh.
This is you have to be
Okay.
exact. Be right on
right.
target. 1 BCF per day. 1 BCF per day. Andy,
Wow.
what do you think that represents?
The expected decrease in electricity generation as a share of natural gas consumption in 2024 or 2025.
Okay. Matt, how about you?
Yeah, I was going to go with the average demand of an LNG export terminal in the U.S.
And Matt, you'd be correct. But Andy, you're also correct. But you got to think like, how was I thinking about that? So
yeah,
Matt,
that's good.
Matt gets
Put
a
myself
point
in your head.
Trick question. I like it. Man,
Like
starting out with the
stay out of
curveball.
Neil's head.
That's right. Starting off the breaking stuff.
Nice. Well, yeah, let's talk about natural gas. A lot going on in this space for sure. I think when we last spoke in February, we were sort of in probably the trough of at least near-term prices, and we have seen a little bit of a recovery in prices since that time, particularly prices for this year. We've started to see some uplift in prices, especially the last month or so, last few weeks. You can see the 2024 numbers are starting to move up. I think a lot of that is driven by concern about summer heating requirements, which we'll talk a little bit more about, or sorry, I should say cooling requirements, summer heat that drives those cooling requirements. And I think also sort of some realization that the producers, I think, are serious about starting to cut back production. We have seen that starting to materialize. That said, the prices for the outer years really haven't moved a whole lot. We saw some uplift in those, a little bit of downward recovery in the last few weeks, but generally speaking, still staying high. The one exception to that would be 2025. You can see that really as of kind of last December, we started to see a downward separation from the other outer years, and that trend has really continued. And there's some reasons for that we'll touch on as we kind of move through this, but we'll hit on kind of supply and demand, storage, weather, and the LNG export landscape, which is ever evolving, it seems.
Yeah, absolutely. So let's talk about that supply demand balance.
Yeah, absolutely. From a supply perspective, we have seen that dip in production that we talked a little bit about last time. I think last time, we were starting to hear from the producers, starting to hear in earnings calls that they did plan to cut back capital investments this year, did plan to cut back production. That has happened. I mean, we are seeing, something on the order of a 2 to 3 BCF per day drop in production versus where we were, call it earlier this year, late last year. I think the projections right now, at least, are that production will start to pick back up towards the latter part of this year and especially into next year. I'm maybe a little bit skeptical of that, at least it happening that quickly. And a lot of that has to do with timing around LNG export terminals, new ones coming online, which we'll touch on a little bit more here in a minute. From a demand perspective, really seeing lower demand from a gas perspective through the winter. We had a very mild winter, so you can clearly see that in the graphics. We talked about that some in the past, but we've started to see it pick up, right? So we're getting, warmer beginnings to the summer. Power demand for April and May definitely higher, and I think overall just a higher dispatch of power generation that's been needed to cover some of these periods when we haven't had as much renewable generation. So overall, from a demand perspective, we've gone from early part of the year being on the low end of that range to now, this time of the year being on kind of the high end of the 5-year range that we've seen.
And going back to that 1 BCF a day, what's the sort of putting that in perspective?
Yeah, I mean, so, think about 1 BCF against a backdrop of, 100, call it 100 to 105 BCF per day of daily production in the US, right? So when you think about 1 BCF a day being kind of the average demand from an LNG export terminal, it represents about 1%. And I think we'll see on a slide here in a second, where we sit today is about 14 to 15 BCF per day of export capacity that's online currently. So it's a material amount of the market for sure.
Yeah. So let's take a look at storage, because I think storage has been an interesting discussion to start the year for sure.
Yeah, no question. More volatility here. I mean, and you can see it in terms of, volatility obviously being on the high side of where we historically have been from an inventory perspective at this time of year. Again, a lot of, being sort of a mild winter, another one, right? We had one last year. We've had another one this year. That's a continuing trend. I also think, from a production perspective, the impact of that growth that we saw late last year and early this year, which has now sort of subsided, that certainly contributed to the very robust storage inventories that we have really across the country. You look at the graphic from a regional perspective, the West Coast is definitely in a much better place than it was a year ago, and that's reflected in the prices. So that's certainly notable. All the other regions, largely sit sort of within the middle of where they would have historically been. But when you think about that, and that's sort of represented by the light gray area that you see for each of those regions. But when you think about that on a seasonal basis, the color bars that you see on that graphic, that shows the range for this, sort of this current period, right? So where we would typically be at this time of year. So generally speaking, I mean, even though from an absolute perspective, we're sort of coming out of the withdrawal season, right? So we're not super high on the spectrum here. From a seasonally adjusted perspective, obviously very high. And that's really kind of consistent across all of these markets.
Yeah.
Which again, that's reflected in the prices for sure. I mean, we've seen from a daily price perspective, I mean, we've had periods, certainly out in West Texas, the producing region, where you've had negative prices, even at times fairly consistently for natural gas, which is a little bit crazy. But even in Houston Ship Channel prices have gotten down, in the 25, 50, 75 cent range on a daily settlement basis, not first of month, not forwards, but daily settlements, really, really low at times.
Wow. Yeah, very interesting indeed. All right, let's cover LNG.
Yeah, a lot to talk about here. I think, when you look at sort of where we've been over the last 5 years, really we've added, starting from essentially nothing in 2017, we've added about about 14 to 15 BCF a day of export capacity so far in the U.S. That is, so again, frame of reference, 100-ish BCF a day of production in the U.S. We've gone from 0 to 15, now having that ability to take that gas away from the U.S. market. So think of that almost as demand, right, for natural gas. That's gas that's going away. Very, very significant, very material, and kind of, you can see the stair step in the graphic on the right in terms of how that capacity has come online over time. What's interesting to me is that when you look at where we sit right now, we are sort of in a lull period, right? I mean, if you look at all the growth that's happened kind of to, say end of 2022 timeframe, the next terminal that's expected to come online won't come until 2025. And so we're in this period where it's relatively stable from a demand perspective. There's not new capacity that's being added yet. It's under construction, but it's not here yet. And so, when you look at kind of the dynamics of what's happened with production, it's almost like that production grew in anticipation of this added demand, but that demand ultimately, because of challenges with construction and permitting and other factors, moved out, right? It moved back in time. And so from a production perspective, we sort of got ahead of ourselves a little bit. And I think that's a theme that we'll need to continue to watch for as we move through this time of, big change from a gas demand perspective. There will be periods where the production gets ahead of the export capacity, and there will probably be periods where the export capacity gets ahead of the production capacity. And that's not even speaking about the pipeline projects that need to happen to enable all of that production. So, part of the story behind how we've landed in this very low gas price environment, at least in the near term, has to do with LNG. And I think the graphic on the left, this is from the EIA, some of their projections about expected sort of actual exports of LNG. To me, I think that low LNG case is probably not a possibility anymore. I mean, we're already sort of past that from a capacity perspective. And most of these terminals have now either take or pay or take or remarket contracts where, generally speaking, unless there's a force majeure type event, some kind of facility related event, that gas is going to go somewhere, one way or another. So I think we're really more sort of in that reference to, even some of the higher cases potentially as we move forward.
Yeah. So short term, ample gas, low prices, but longer term, the view remains pretty bullish.
Bigger questions, for sure.
And then as far as near term too, that's going to all be influenced by weather. And I think definitely in Texas, certainly across, the southern half, anticipation of that summer certainly adds to demand expectations, pricing expectations. So certainly top of mind as we get closer.
Yeah, I think for folks that know me, I do have some skepticism about weather forecasts that look beyond the next 30 days personally. But yeah, I think that's exactly right. I mean, to quote Robin Williams in Good Morning Vietnam, I mean, this map is telling us it's going to be hot. It's going to be dang hot. It's going to be real hot, right? Pretty much everywhere. I think there's some further color that comes after that, but we'll stick to the G-rated version for this discussion. And I think it's a concern, right? Like you said, Texas is a concern for sure, because that will drive significant load for electricity or demand for electricity. That Northeast forecast is a concern too. I mean, if we get sustained hot periods up in, Ohio, Pennsylvania, New York, New Jersey, those are areas where you will see big spikes in demand for electricity for cooling requirements. So that's a concern. Obviously, we're talking about gas right now, so that's a concern from a gas demand perspective, but we're about to shift into power, so that's a good segue into, impacts that we'll see there. The one thing I'll note on the precipitation side, and it's not as much captured here because this is forward looking, but we have had a lot of rain in Texas for sure, and in some of the other parts of the country that could help to maybe mitigate that forecast a little bit. Usually going into a summer, if we've had a lot of rain, there's a fair amount of moisture in the ground that helps to keep things a little bit calmer. But again, I try not to look at weather too far forward. That's just me.
It's probably a good policy. And me personally, I'm hoping that this ample precipitation we've had gives Texas a normal, regular summer and not a repeat of last year, for sure.
That'd be nice.
Yeah. So let's move forward to electricity markets. And my next trivia question. So we're going to cover ERCOT. I struggle between which number. So I think I'm going to go with because it's near term. So give you a little hint: $330 a megawatt hour.
I'll go first. The real-time average price for May 8th.
Hey, I just want the record to reflect that as he gave that answer, he was looking at one of his other computer monitors, and this is not supposed to be an open book exercise.
No one said it
At
was.
least I was told that.
Hey, whoa. So you're filing a protest already? I mean,
I'm filing a protest. I'm going to say the average hourly LMP, real-time LMP price in the month of May for hour ending 7 p.m.
Okay, very specific, but I think I'll award a point to both of you guys. Were right. That's definitely what we saw in the real time. We'll cover, sort of what that impact was and what led up to that point. But first, let's cover some national regulatory news, certainly as it applies to the electricity grid.
Yeah. Thanks, Neil. So the EPA just recently released their new greenhouse gas reduction rules. This is the first time that the federal government has directly restricted CO2 emissions from existing coal-fired power plants. It's going to result in significant reduction in emissions required utilizing carbon capture for the first time on a large scale. Currently, it's focused mainly on coal. But the existing natural gas plants will have a rule sometime in coming years that will be very similar in nature, I would assume. Specifically, coal plants that are running more than 40% of the year will be required to reduce 90% of their CO2 emissions by 2032, with lower restrictions, meaning less restrictions on plants that are going to retire before 2040, but also those plants retiring before 2040 will be required to have gas co-firing requirements at some point post 2030. So quite a bit of change from where we've been in terms of, really not a lot of restrictions on emissions from coal-fired assets in the past. If this rule is upheld or not stayed, it's going to avoid 1.38 billion metric tons of carbon pollution through 2045, which is a pretty substantial amount of reduction. And it could actually mean some coal plants, retire ahead of schedule. Assets that are already non-economical that have to invest additional capital to meet these requirements could decide that that's just not going to make sense, and they'll just take the plant down early if possible, which would result in less dispatchable generation in some of the coal-heavy regions, which could be impactful for resource adequacy concerns sooner rather than later. Currently, this rule is being touted by the Biden administration and environmental groups heavily as, the way to go forward, the way to really meet a lot of the goals out there from a national sustainability perspective. But it's also being challenged quite a bit by generation owners, citing that carbon capture technology requirements are not really ready for large-scale deployment to meet this requirement by 2032.
Yeah, certainly in the face of what kind of the back half of our discussion, this is certainly important facet of that. So let's Andy, let's cover ERCOT. Let's take a look at what's happening here and speak to that $330.
Yes. So ERCOT forwards have continued to climb amid speculation of massive load growth fueled by the recent ERCOT CEO board update that was in late April. We're going to speak about that a little further in the load growth section. But he stated that there could potentially be up to 40 gigawatts of additional load by 2030, which would be effectively a 50% increase over the existing kind of peak demand today. That's a big number. That's not something that just gets thrown around lightly, I guess, at the CEO level at ERCOT, but it's out there. That's probably debatable on whether we're going to get there, but it is something to keep our eyes on. Looking at how we meet that supply or that requirement from a demand perspective is important. So looking at the fuel mix, we've seen a substantial additional solar capacity brought online since last summer, which is continuing to provide a higher percentage of the supply stack. If you look at the chart on the right, you can see the 2024 number for solar versus the 2023 number. It's almost double on a year-to-date basis, almost on par with nuclear, which is pretty substantial, and actually not that far behind coal thus far in 2024. Additionally, battery capacity has grown substantially over the last 9 months, such that on May 8th, we saw 3.2 gigawatts of batteries deployed across a single hour, which is almost a 50% increase over previous battery peak hour deployments. On May 8th, additionally, if we hadn't had these batteries, we would have seen substantially higher prices across a longer duration of hours than we actually saw. So on May 8th, we saw real-time average $333 across the day, and actually hit the cap of $5,000 per megawatt hour for a 15-minute interval beginning 8 p.m. Mainly this was driven by low wind generation, which was expected. If you look at the day ahead prices, they were actually elevated into the thousands of dollars for the kind of the 5 to 9 p.m. period as well. But wind did show up as expected. However, there was elevated load on that day due to some heat and substantial outages in the 21 gigawatt range for thermal assets, which resulted in prices spiking higher than even where day ahead had cleared at. Without these batteries, this would have been even worse than it was. Looking at monthly real-time averages, overall, with the exception of really May, real-time has been rather benign in 2024. The majority of the monthly averages have been below historical averages, but as Matt alluded to in his weather update, we'll see what the summer looks like, and we could see some return to average LMP prices or even higher as we move into a expected hotter than normal summer. We have yet to see ERCOT release either their seasonal assessment of resource adequacy, the SARE report, or the capacity demand reserve report, the CDR. But expectations are for increasing peak loads even over last year. I'm not saying from like a peak demand perspective, but just the expected amount of gigawatt hours demanded across the summer is expected to be higher than previous years as continued load growth in Texas occurs from residential growth as well as industrial growth. The solar ramp hours and hours ending 6 p.m. to 9 p.m. will be the most impacted, and wind generation will need to be abundant to help avoid high LMP prices this summer as we lean on substantial assets to meet those peak demands.
Yeah, I think that's a good segue into the next topic here of how prices are changing. Certainly that advent of solar coming online, certainly when the percent of load is giving rise to a different shape in the ERCOT daily.
Yeah, that's exactly right. So as I mentioned in the previous slide, wind generation is key to managing that late afternoon, early evening peak hours. And then the chart is the average hourly price for each of the first 5 months of the year through May 14th, sorry. So as you can see, there's kind of two peaks. There's the morning peak prior to solar really reaching kind of max capacity or substantial capacity. And then there's the larger afternoon peak that is, getting worse and worse as you move through the month. So, looking at Jan, that morning peak was worse. Feb, not much of a peak at all, both periods. But then March, April, May, it starts to kind of ramp up quite a bit. You can see enhanced volatility, as it's needed to backfill for substantial solar generation declining in the late afternoon hours. While solar is doing a fantastic job of supplying daytime power, as denoted by the very low kind of trough period between really 7 a.m. and about 5 or 6 p.m., when its counterpart wind generation doesn't show up in meaningful quantities, whether that's forecasted to do so or not, it can escalate prices pretty quickly like we saw on May 8th. And in fact, that blue line is pretty much a direct result of May 8th. If we took out May 8th from all of the other days of the month for May so far, it would be substantially lower even than April across this kind of shape period. Additionally, you can see this is not just a summer phenomenon. We haven't even gotten into summer yet, and you're seeing what I would call the beginnings of a little bit of a duck curve here. You're seeing that solar ramp out peak become, a significant concern in the late afternoon hours, and this could only, potentially get exacerbated worse as we move toward summer, particularly with more and more solar coming online in future years. We would expect that trough in the middle to actually decline even further, knocking more thermal generation off of the grid during those daytime hours, which is only going to increase the cost that they're going to bid in at, or the value they're going to bid in at in the afternoon hours, driving up that ramp hour pricing into, potentially even substantially higher than where it is right now. So yeah, it's an ongoing phenomenon we're going to keep our eyes on. But yeah, when you start losing thermal across a 24/7 period, that becomes an interesting phenomenon to work through.
Yeah, feels like there was a lull, the first couple of months of the year, just looking at the price averages. But I think a sleeping giant has been awakened.
think that's very possible.
And speaking of thermal, so talk a little bit. Voters passed the legislation for the Texas Energy Fund. I mean, does this thing give us any sort of view of new generation coming online? Like, what's the what are folks expecting?
Obviously, ERCOT has some concerns around how they're going to meet the grid reliability and resource adequacy with increasing loads and more intermittent resources, providing a larger supply of the generation stack. So the Senate passed Bill 2627 to really provide financial incentives for thermal generation to be installed in ERCOT and even Texas at large via the Texas Energy Fund, which creates about $10 billion of low-cost funds, which at a 3% interest rate on the larger $7.2 billion that's allocated for generation. That's for ERCOT specifically. Has to be a minimum of 100 megawatts of capacity, 60% available to the grid, that meaning not going to a behind-the-meter type load. And then additionality, there is another $1 billion for in-state but not inside ERCOT generation and T&D upgrades and installations to really help just fortify the entire state and not focus on just the deregulated or the ERCOT portion of the state. Additionally, there's another $1.8 billion earmarked for resiliency applications to provide backup power supply at communities like hospitals, public safety load, fire stations, police stations, other things like that, where you need to keep them online regardless of what's going on with the grid reliability concerns. And then looking at kind of where this is right now in terms of projects, there have been 9 projects submitted into the fund to date, with about 3.5 gigawatts of capacity that have noticed intention to apply once open applications are available. So I think this is it's a bit of a change in direction for ERCOT in terms of really putting out some sort of opportunity to create thermal supply that's not just market based, but I do think it's something that if people use correctly could be very beneficial in the coming years as we see some of our older thermal generation retired, as well as we put more and more intermittent renewable generation on the grid. Having some low cost, highly efficient generation to backstop that will be very attractive in the future.
Yeah, and we think these were projects that were likely on the sidelines at one point. I mean, what percentage do you think these are brand new, and kind of what's the runway for this next couple of years, I suspect?
They have to have these interconnected by June of 2029. But I would say more than half of what's in that kind of notice to intent was already kind of sidelined and had at least initial plans already kind of developed.
Yeah, I agree.
Yeah. Okay. Well, very good. Thanks, Andy. We're going to move into PJM now, and I'm going to throw you a number, and you guys tell me what you think it is. This should be easy because I don't think there were a lot of numbers printed on this slide. 45%. 45%.
Go ahead, Matt.
5%. Yeah, I'm going to say the percentage of generation that came from coal so far year to date in PJM.
Andy, what do you think?
That's pretty high expectation for coal.
That does feel pretty high now. Can I change my answer? No, go ahead.
I would say it's the non-natural gas supplied generation, maybe.
Man, you guys are so close. So close. This is actually the correlation now from probably what was heavily coal is now tied to natural gas in PJM.
Yeah.
And that's what's driving a lot of these shapes.
I was off on my percentage for sure. That's a good one. I like that. Yeah, so let's talk PJM. One of the themes that we're going to touch on here at the end in kind of our deeper dive subject is load growth, and we are definitely hearing about that in PJM as well. Maybe not quite as severe as what's being discussed in ERCOT, but we'll hit on that again here in a little bit. You're seeing prices from a forwards perspective, definitely saw some upward lift in outer years. Near-term prices from a forward perspective remain pretty low, kind of tracking natural gas prices. Obviously, as I said, from a generation mix perspective, still very heavy on natural gas, and so the prices there tend to follow that. From a wind and solar perspective, PJM is still not a market that has real high penetration of either of those technologies. That will probably be changing as they sort through the recent interconnection queue reforms and start to get a lot of the projects that have been in that backlog, now potentially moving forward. That said, certainly think that this is a market that's going to continue to be heavy on the natural gas, coal for a while, and certainly nuclear, obviously, as well. From a spot price perspective, there again, more recent spot price settlements have been following that low natural gas price environment, low overall spot price settlements, even through the winter, as again, didn't really have too much of a winter, no crazy storms or anything like that. One thing that's maybe worth noting, we did get kind of the first insight into capacity prices in the future that we've had in several years because of some issues with some FERC disputes that were going on between PJM and FERC and some various generators. Largely, I'll say, not a lot of change, not a lot of volatility in the capacity prices for the next planning year. I think that's maybe more of a concern as to what that portends in terms of potentially, accelerating retirements of capacity, which, would not be great at this time, given the load growth that's coming. And also the potential that, down the road, we could see higher energy prices if those capacity prices don't recover some. So one that we'll, certainly cover in some more depth, probably in a future one of these.
All right, moving east to west across the country, we're going to talk MISO, and I've got another percentage number for you. You can tell me what it reminds you of. 30%. And I'll say it's a decline of 30%.
Well, but beyond being the Houston Astros winning percentage right now, figured you were going to throw that one in there.
Hey, man, I'm trying to stay neutral. It's early season. Got nothing to brag about on this side of the house either.
Oh, that's true. We appreciate that. It's keeping it close. Decline of 30% in MISO. I'm going to stick with the coal theme and say decline in capacity expected over the next 5-6 years by 2030 in coal capacity in MISO.
I'm going to stick with coal as well, but I would say the decline in coal production of energy from 2021 to 2024.
Wow. Let's check it out and see.
Let's see.
Looks like, well, when I had it before, it was the decrease in, it was the well, you know what? It's coming up in the next slide. So go ahead.
Oh, there you go.
Talk about prices. Yes, sir.
Nice. Yeah, so from a MISO perspective, seeing definitely a bit more volatility here than PJM. I mean, the forwards definitely saw the run up. I think really the kind of response to the downward movement that you see was probably triggered by capacity auction results that came out. There we'll touch on some more detail there, but I think the balance of capacity and energy in this market maybe looks a little bit different, versus a PJM. From a real-time price perspective, similar to PJM, relatively low, certainly still a heavy gas market. And so these low spot gas prices are keeping things low from a power demand and a power price perspective, I should say. I think going forward, there's open questions about certainly resource adequacy and load growth is an issue here too. But I think in kind of the near term, our view is that I think prices will remain relatively low from a spot perspective. But as we get into these future years, that could start to definitely change. And the forwards are telling us that, right? So yeah, maybe diving a little bit deeper on the next slide to talk about some of the things that are going on from a longer term perspective. Definitely seeing maybe the earlier stages here of the transition in the supply mix versus where an ERCOT or a CAISO is today. Certainly a lot of projects, new generation projects that are in the queue from a wind and solar perspective. There's also some gas-fired generation that's in the queue. Keep in mind, MISO is a market that is mostly regulated. And so a lot of these utilities, are looking to assets that they can deploy fairly quickly and also can deploy to help serve sort of baseline load. As they retire coal plants, as they retire some of the older gas-fired generation, that's definitely a part of the equation too. But one of the challenges with kind of moving through that transition is transmission. And this is something that we'll touch on when we talk about load growth as well. But this is becoming a major issue in a lot of these ISO regions and a lot of the utility territories as you add more generation, as you retire more generation, and that generation that's being added is in different locations. And a lot of times you think about solar and wind, it tends to be in areas that are very different from where you would have put a coal plant or a natural gas plant. So MISO, if you recall, originally had a $10 billion price tag for their sort of phase one transmission plan, long-term transmission plan. This phase two is looking to be about a $17 to $23 billion cost. And overall, that's part of a broader plan that's expected to be somewhere in the vicinity of $100 billion over, many years, obviously, as the grid changes, but very significant from a cost perspective. And keep in mind, all of those costs have to go into the rate base. They have to be recovered, right? So I mentioned earlier the large amount of projects that are in the queue. There's a total of about 310 gigawatts of potential capacity that's in the queue today. MISO has one of the longest timelines to get through that application process. So anywhere from 2 to 3 years to get an interconnection agreement, and then potentially just with construction and grid upgrades that are required and everything else, another couple or more years to get actually into service. So very substantial lead time to get a new generation facility built. And another theme, and you'll hear this from us again in the discussion about load growth, the independent market monitor in MISO has been critical of the ISO for assuming that all of these renewable projects that are in the queue will get built. And I would argue in their defense, they're probably not assuming that every one of them will be. But even if they're assuming, 40 or 50% of them will be, that's significantly above the national average, which is about 14% of projects that apply to interconnect actually get built and come to the grid. So pretty big disparity there. And it does raise the question of, how much money do you invest in infrastructure for generation that may or may not come? I mentioned the capacity auction results. So definitely continuing to see the theme of a lower amount of surplus capacity as we continue to see more retirements. And again, new generation being slow to come to the grid. Some zones are more constrained than others. Zone 5, which is most of Ameren's territory in Missouri, there are some issues there for sure. And we see that reflected in the capacity prices from a seasonal perspective primarily. But overall, I think we see upward pressure on capacity prices in MISO, and obviously that's going to flow through to everyone's invoices. Different areas will be affected differently. As I mentioned, Ameren is more heavy on coal than some other regions, and so they'll be more impacted potentially by the EPA ruling. If that sticks, that's obviously the big question. I think we're on, I don't know if this is round 2 or round 3 of the EPA attempting to regulate carbon emissions. So that is a very big question. We have to be careful of assuming that will stay.
Yep. And then moving further west, my trivia question has to do with an ample resource. I think it's important when you talk about California. So the percent I'll give you is 127%. And it's not tied to my effort in preparing for this webinar.
Well, we know that.
I drafted this slide, so I do know this number because it stuck out in my head.
So Matt, you get to go first, it sounds like. The benefit.
I'm gonna say the percentage increase in hydro generation year over year, 2024 versus 23.
Not far. I think it's actually the current snowpack relative to historical norms, but
there it is.
So it's in the right realm, at least.
You're
right.
close.
It was.
Yeah.
Half a point.
Yep.
All right. Yeah. So quite a bit of snowpack this year. Strong hydropower thus far. Guess we can kind of start there. So, looking on the year-to-date fuel mix on the right over here, yeah, you can see hydro above all previous years thus far, and with 127% of historical norms. There's also been some delay in the snowmelt such that that's expected to actually continue with strong hydro through the balance of the summer as we get into some warmer weather finally and later here in May in California. Additionally, solar has been well above historical averages as well, as more and more solar generation has been installed in the last 9 months to a year, such that solar is now the overwhelming renewable resource, substantially outpacing wind and hydro at this point in time. Combined, those three, hydro, wind, and solar, have provided 44% of the annual generation year to date, while natural gas is still the largest contributor, closer to about 40% of that generation supply. LMPs have been, very, very low across CAISO this far this year, really supported by the amount of solar production during daytime hours as well as low hydro, really providing a low cost, base for that on peak daytime generation. That being said, there have been some recent pops in the afternoon hours, but prices overall in LMP have been pretty attractive. On a forwards basis, we've seen quite a bit of softening over the last 12 months for really all of the forwards in CAISO. There's been a slight uptick in recent week or two, but mostly it's traveled down with natural gas and staying kind of in line with that. Obviously, the low cost solar, hydro, and wind generation is certainly supporting keeping those forwards down quite a bit. I don't have a chart on this, but on the flip side, RA and RPS are through the roof. 2025 RA or RPS costs right now are estimated to be north of $30 a megawatt hour, while RA is closer to $80 a megawatt hour. So more than the actual underlying energy price at this point in time. And like I said, I don't have a chart on that. That's certainly driving end users' cost quite a bit.
That's staggering. Yeah.
Yeah, it's pretty aggressive.
Sure.
So I think, moving on to the next one, we can go into a little bit more on why LMPs where they are, and there we go. So we've seen substantial solar curtailment this year. So while solar's been a significant supply source for meeting demand, it's also being curtailed because there's still not enough battery to move solar to the peak afternoon ramp out hours, and strong hydro production is continuing to supply the low cost power in conjunction with solar on day peak or daytime hours. We've also seen this large amount of solar start to increase the severity and the number of instances of negative day ahead and real time prices seen during the solar hours. So much so that if you look at the chart on the right, SP 15 daytime hours in April averaged $29 per megawatt hour negative and in real time, and then NP 15 was $9 per megawatt hour. But you can see that there's been instances where prices have been, negative $50, and then multiple instances of prices in the negative $10 to $20 range, almost upward of 250 hours of negative in the $10 to $20 range. So substantial negative pricing due to the inability to shift on peak solar power to other hours of the day when demand is not being met by solar. This is creating potentially what's a permanent price differential now between SP 15 and NP 15. You can see it in the charts. If we were to go back to the previous slide and I showed you NP and SP, they would be different. There's a $10 to $15 differential there now between those two on a forward basis, but even worse on real time and day ahead. And this really has to do with where the existing solar generation is sited, mainly in SP 15, and where most of the proposed solar generation will be sited, such that you're creating a preponderance of low cost or zero cost marginal generation in SP 15 that doesn't necessarily have a great path to get to NP 15. Looking back on the other side, as CAISO continues to move forward towards its RPS goals of 60% renewable by 2030 and 100% carbon free by 2045, it also requires increasing the supply of renewable generation. And the lion's share of that generation is expected to come from solar. However, that creates, even further challenges. So as you try to integrate, what the state has said that the ISO should plan for 85 gigawatts of additional renewable and storage capacity by 2035, that means there's a lot of projects to go through and evaluate whether they are going to be able to be installed and operational moving forward, such that the CAISO delayed the cluster 15 submissions to try to work through some enhancements for cluster 14 and try to get ready for the large expected number of submissions associated with cluster 15, which totaled 347 gigawatts of capacity. So of a preponderance of solar and storage really that won't get built for the most part. Obviously some of that will get built, but as Matt alluded to earlier, only 14% of projects submitted into queues get built nationally. But it's a lot of work for the staff to work through all those different projects, identify which ones are the best fit for the ISO moving forward. In addition to just RPS, there's also, as I mentioned earlier, resource adequacy, or RA, and they're moving toward, the CAISO is moving toward a slice a day or hourly RA, as we're kind of calling it, which is forcing the ISO to make some hard choices to meet those RA requirements, which includes extending the operating term for Diablo Canyon nuclear facility, as well as pushing out retirements for existing gas plants to allow them to continue to operate for a few more years so just so the ISO can get caught up in terms of battery storage to move some of that solar to other areas of the day that need to be supported better. And even more striking was that the CCAs now, so those are community choice aggregators, are actually looking to procure thermal generation for 2025 to meet their RA requirements, which is that's like a 180-degree change in direction for a CCA to look at thermal generation. So yeah, a lot going on in CAISO. When we were putting this chart together, I actually thought about just like making it a big bullseye and having all these different things pointing at the CPUC or the CAISO board. But yeah, they've kind of put themselves in a really tough situation and are ahead of a lot of others in hitting some of these concerns earlier on.
Yeah, very good. All right, so let's wrap our discussion today talking about load growth. Like I said, this is a hot button topic in the industry, and it's not just affecting one single region. It seems to be across the board. So I'm going to do my trivia questions. I'm going to let you guys kind of volley back and forth here. And the first one's an if-then. So you tell me the result. I'll tell you the if.
Ooh.
If 25 to 30 BCF a day load growth, then what?
Andy, you to go first this time.
25 to 30 BCF a day
in gas consumption growth?
Growth?
Or you said load growth, so that's why I'm kind of like, you mean like BCF a day of gas consumption or demand?
He's just stalling. We need a time limit.
And totally stalling. Totally stalling.
If that demand, then what does that equal?
I mean, much higher prices. I mean, natural gas is going to go through the roof.
I'm gonna say 14 gigawatts of power demand.
That's it. That's right.
It's meant to be gas to power. And then the last number, I think I got this right. It feels weird to say greater than 160 gigawatts.
Oh, I know this one. This is what
peak demand, potential peak demand in ERCOT.
Yeah, that's exactly right. That's where I was going to go to.
Unbelievable, right?
So these are unprecedented times.
I'm buying steel stocks right now if that's going to happen.
Yeah. No, it's a good intro for sure. And one just administrative note: we probably will run right up against time. So if folks have questions, please by all means feel free to throw those into the chat, and we'll be happy to give some quick answers as we move through this, or happy to stay on for a few minutes after to make sure we hit those. Load growth, no question, probably, if not the biggest, certainly near the top of the list of subjects that we're discussing and sort of dealing with every day. And you don't have to look far. I mean, we've got some headlines here. We can probably fill a page with headlines that you're seeing in newspapers and magazines talking about the amount of demand for electricity that is coming to the grid that's new. I think this is probably unprecedented unless you go all the way back to the times when the world was electrifying, really. I mean, utilities, independent system operators, they just have not seen, markets have not seen this kind of growth in demand for electricity really ever. And so there's a lot of issues that come along with that have to be dealt with. When you think about the type of industries that we're seeing this growth, I think the near term is certainly data centers, crypto mining, maybe to a lesser extent, but the big one is definitely data center demand that's driven by artificial intelligence and the computing power and the power demands associated with that that's out there. Oil and gas production is another big area for sure, and that's sort of both with the upstream assets, the production assets themselves, and also the midstream assets to get that energy to markets. And some of that is electrification of existing facilities. Some of it is new facilities that are being built that will need electricity to power those operations. And some of that demand from oil and gas production is ultimately to feed the LNG export terminals that we talked about earlier. But when you think about those in the context of a power discussion, they do require a significant amount of electricity to power their operation. So very significant driver in the power markets as well. Domestic manufacturing, reshoring is definitely real. We're seeing more industries that are bringing facilities, either older facilities that had been running at a lower capacity or, even shuttered, bringing those back, or certainly building new facilities. And so all of that definitely contributes to demand growth. EVs, if you read the headlines, that's maybe slowed a little bit in terms of adoption rates, in terms of sales, things like that. But we do still have it on the list as something that is going to drive demand growth. The pace of that, the timing of that, maybe an open question. And then from a clean energy transition perspective, a lot of the things that were driven by the Inflation Reduction Act, green hydrogen projects, green ammonia projects, those all sort of sit within that category. From a timing perspective, Andy, I don't know, do you think we have this right in terms of what we see, how quickly these come and sort of the order of this? And what is your feel for kind of the overall timeline?
I think from a national perspective, I think you're pretty right on. Obviously, if you look at this from a geographical, perspective, that there's obviously going to be certain items that are not as impactful in some geographies and even more impactful in others at different time frames. So like California obviously is much further along on electrification, clean energy transition, electric vehicles, but doesn't really have much going on in the oil and gas or LNG export space at this point in time. So yeah, I think you're right from a national perspective, but it is interesting to see how that's going to drive demand growth differently on different time frames in different geographical regions. So
yeah, it's a great segue into the next slide. The when you sort of focus on maybe the data center and sort of the crypto and AI space first, there I think we do see pretty good geographic diversity across the country. I mean, there's definitely hubs where you see a lot more activity than other places, but they tend to be pretty spread out. Dallas, Northern Virginia, Atlanta, on the West Coast, parts of Washington, things like that. Today, data centers represent about 2.5% of U.S. electricity consumption. That's projected to go to about 7.5% by 2030. I mean, we're only talking about 6 years. That's really staggering, and that represents obviously a significant amount of growth in demand for power. One of the challenges of these data centers is you can build them relatively quickly. However, the timing required to get the amount of power needed for those facilities to them is obviously, a lot longer. And so that's a challenge that a lot of data center developers are dealing with today. But the graphic tells the story. I mean, the projections are that there will be significant new load coming from data centers in the next few years. And we're seeing that. We're seeing that on the ground for sure. Andy, I talked a lot about LNG exports. You want to touch on what that sort of means from a power demand perspective?
Yeah, sure. As we talked about with Neil's question, 25 to 30 BCF a day of additional demand equates to roughly 14 gigawatts of electrical demand. So as you're thinking about the requirements for moving, that amount of natural gas from a gaseous form into a cooled liquid form, that takes massive amounts of power. And that power is going to be pretty much concentrated in really the Gulf Coast of Texas and Louisiana and maybe a little further east of there. But it's a massive opportunity for, industrial growth in those regions, which already pretty much exists on the Gulf Coast of Texas. But how we get that infrastructure built and we meet the demand of the LNG export terminals is going to be an interesting conundrum between now and 2030, not just on the power side, but if you think about, we talked about the natural gas segment earlier, they're both in kind of a very similar correlated period right now. We've got strong natural gas production, but pipelines need to expand to be able to move this to the point where we can get it cooled and sent via LNG terminals to other locations worldwide. Whereas powers, has generation now, but it needs to be changing to a more renewable, based fleet. But we also have to then interconnect all those. So that it's the same issue. Pipelines now become transmission lines for power side, and we have the load coming, but how do we serve that load? And so I made a joke earlier about investing in steel, but I think it's three parts that are kind of all very highly aligned across both natural gas and power right now, which is the supply, which I think is not going to be a problem. It's the demand is definitely going to be there, and then it's how do you get it all to where it needs to be at the right price point is the big part that I think I'm most concerned about right now.
Yeah, yeah, and I think all of this leads to, the timing being very chunky. That graphic on the LNG terminals coming online sort of illustrated that.
Yep.
So, next question, sort of how are the independent system operators, the ISOs and the utilities dealing with this? Yeah, no, you can go on to the next one. It's perfect. As I said earlier, I mean, it's pretty unprecedented, right? So you are definitely seeing some struggles with how to sort of go about planning for this. So we're using ERCOT here as an example because it's probably the most extreme that we've seen, at least so far. Historically, ERCOT's planning process was really to only consider sort of known demand growth, projects that were already in process of interconnecting with a utility and were, 80 to 90%, maybe 100% certain we're actually going to come to the grid. Well, post-URI and some of the legislation that was passed last year, the PUC and ERCOT have been directed to now consider all potential load that could come to market. So that means talk to the utilities, find out who they're having conversations with, what projects are out there that could potentially happen, everything under the sun, right? Things that are long shot, bids, things that might or might not happen. All of that's now going into the mix. So as I think Neil alluded to earlier, the CEO of ERCOT presented at a board meeting this graphic that you see right here, which shows the potential that within the next 6 years, we could see peak demand in ERCOT of 160 gigawatts. Will that happen? I think it's completely physically impossible. The amount of infrastructure that you would need to get to that level of peak demand, I just don't think can get built in 6 years. And I think some of this is perhaps the backdrop of this a little bit too, is wanting the market to have the view that, yes, we expect robust load growth. We want people to invest in generation. And so wanting to kind of push that narrative further along. But nonetheless, as you saw in the graphics on price, it certainly had an impact. When we talk about some of the other regions of the country and some of the other ISOs and utilities, it's the same story, right? That you go on to the next slide, it kind of gives you a view of some of the things that we're hearing and seeing. In markets like, Georgia, as I mentioned earlier, heavy data center development demand market, they're expecting, 6.5 roughly gigawatts of new demand to come to that grid in the next 7 years. That's a huge amount of demand. Andy said it earlier, we talked about the LNG terminals. If we truly add another, and if you remember back to the natural gas slides, the higher cases for LNG exports were up in the 40, 45 BCF a day range. That would be an incremental 30. That's basically the equivalent of adding the power demand of the state of New York. I mean, that's staggering, right? And all of that would be concentrated in Texas and Louisiana. Data center demand, being driven up in the Duke area, in PJM. Certainly, a big part of that 10 gigawatts is definitely data centers. AEP's highlighting, the potentially they want to have a sort of a separate bucket of, commitments specifically to serve data centers. PG&E, the West Coast, you're seeing the same thing. So all of the regions of the country are seeing sort of these trends, and it's just a matter of how do they sort of deal with it, right? How do they deal with all of the challenges that come with this and integrating this into the grid? And so with that in mind, on the next slide, how we see it in terms of the major issues that are out there in getting this new load to the grid. From sort of you think about it starting at one, if you want to site a new facility, the first thing that you have to look at is the immediate area, the distribution, the local infrastructure that exists there, and can it handle that demand? And if we're talking about a data center, an LNG terminal, you have to build significant infrastructure, substations, things like that, right? So the processes that utilities and ISOs go through to interconnect those types of loads normally, they're not built to handle the kind of volume that they're seeing today. And on top of that, the timelines to get some of the materials, some of the equipment that's needed, whether it's high voltage breakers, whether it's substation infrastructure, building those new lines, all of that takes time. And that's kind of, again, at the local level. So think about it as on-site and sort of the transmission and distribution that's near to where that load is. But you sort of go to the next step of that, you look beyond that from a transmission perspective as you add more load to the grid. And by the way, we're also adding more generation to the grid, like we talked about, right, in different places. And that adds a need for more capacity to move power around the grid. And these are not projects that can happen overnight. Obviously, a lot of these markets are already trying to get out in front of this. We talked about MISO's plan. ERCOT has a number of projects that are in the works. PJM is the same. But these things take anywhere from 2 to 5 years from a planning perspective, from a siting perspective, a routing perspective, approval from the various regulatory agencies that you need to get. All of those things take quite a bit of time. And so that is another area where you have the potential for bottlenecks for sure. And then lastly, on the generation side, you think about adding all of this additional load. Most of these markets that we're talking about don't have a lot of excess generation capacity. And so there's going to be a need for new generation to come to those markets. That also doesn't happen overnight. And it's different. You think about the type of assets that are needed. Most of what's in the pipeline today, wind and solar, in some of the markets, there is some gas. Most of these loads, if you go back to that list, they are, pretty consistent 7x24 loads that need power all the time, not just when the wind's blowing or the sun's shining. So there will be a need for not only the wind and the solar, but also for dispatchable assets. And as we talked about in the last discussion on storage, I think that can be a part of the solution, but from a cost perspective and just from a technology perspective, we're probably not to where batteries can really carry you through the daily and certainly the seasonal differences that you get in output from wind and solar. And then lastly, from a market structure perspective, this is a challenge in obviously both regulated and deregulated markets. In the regulated markets, the regulators struggle with, do we go ahead and authorize utilities to build all this generation, even though we don't know that all this load will come, we could saddle the rate base with a bunch of unneeded generation. In the regulated markets, it's whether or not investors are willing to put capital in. And so that creates, concern about, does the generation get there quickly enough? Does the load show up or does it not? And all of that ultimately is leading to more volatility in prices. We expect generally upward movement in costs, and that's going to be on the commodity side and on the delivery side. And if you go to the next slide, this sort of tells the story, right? You look at these markets, you look at the forward prices, certainly you're seeing it in ERCOT, certainly you're seeing it in PJM and MISO, maybe not as much in CAISO, although there certainly is disconnects between the near-term prices and the longer-term prices. And I think a lot of that is being driven by expectations for demand to go up and the open questions around, can the infrastructure, can the generation be there, to serve that load? And I don't want to pretend that it's a reliability concern, at least not at this point yet. It's more of a price concern. What assets are you having to run? What are the marginal costs of those units? And that's what's driving a lot of these prices. But I do think everyone has their eye on the potential for reliability concerns too. So we wanted to highlight this. I think it's an issue that is definitely a big driver of markets right now, and we think will be creating a lot of volatility. It's kind of, we're raising the flag a little bit to say, hey, we've been sort of in a quiet period here for a year and a half from a commodity price perspective. We're probably moving out of that going forward. So I know we're a little over on time, Neil. I'll hand it back to you.
Yeah, thanks, Matt. I think this was great information. Thanks again for joining. As mentioned before, we will make all of this available, including the presentation materials and the recording. And then certainly we are always available to answer questions, talk more about any of the specifics presented today. Happy to help alleviate any concerns or certainly help build strategies and perform the proper planning to mitigate some of these impacts. I think with that, we're going to wrap it up for today.
Stuff.
Sounds good.
Appreciate it, everyone.
Yep.
Appreciate it, everyone.
Talk to you all soon.
Have a good day. Take care.